In the bullish scenario, a candlestick-based inducement occurs when the price breaks below or effectively sweeps the liquidity of the lowest point of the bearish candle, representing the most recent valid pullback. For example, in the given illustration, we see that the price has created successive minor and internal impulse and corrective movements before entering the retracement phase and experiencing a temporary downward movement with these three red candles. The price has broken and closed below the latest internal pullback, indicating a valid inducement and confirming the upper high as our valid major high. Similarly, in a bearish scenario, a valid inducement occurs when the price breaks above or effectively sweeps the liquidity above the most recent internal pullback, confirming a new major low and already a new break of structure if the price breaks and closes below the newly confirmed major low. It's crucial to note that for having a confirmed inducement, the price must break and close above or below the most recent major high or major low and form a valid break of structure. If you look at the bullish diagram, you can see that the price has broken out and closed above the latest major high, indicating valid inducements and also a valid break of structure. Here, we have identified a valid break of structure. Now, after the break of structure, where is the potential inducement area? We can see that the price created an internal pullback before it broke and closed above the recent major high. So, in this case, the lowest point of this red bearish candle becomes an inducement, and we are expecting the market to retrace back down, take out and sweep the liquidity below it, and confirm this high as the new major high. After mitigating the extreme demand zone, it should reverse and continue in its upward direction, also creating a new break of structure by breaking and closing above the most recent higher high. Before delving into the next topic, it's essential to consider some crucial points when identifying candlestick-based inducement on your price chart. To identify a valid inducement, as mentioned earlier, the price must take out the lowest point of the bearish candle, signifying the most recent valid internal pullback. This can happen either with the body closing below or with a wick that sweeps liquidity below the candle and then retraces within the range of the lowest point of the latest pullback, as illustrated in diagrams 1 and 2. In contrast, as depicted in the third diagram, the price did not succeed in surpassing the lowest point of the latest internal pullback, either with a body closing below or effectively sweeping the liquidity below it with a wick. Consequently, we cannot regard it as a valid inducement. Rather, it signifies a single impulsive movement. Now, let's understand the importance of considering inducement in our trading strategy, and why it's crucial to identify and highlight inducement areas on our price charts. To illustrate this concept, let's suppose we have bullish structures like these that simulate price movement. As you can see, the price is currently in an uptrend and has generated successive minor and internal impulse and corrective movements before entering the retracement phase, experiencing a temporary downward movement with these three red candles. It's clear that the price has taken below the latest internal pullback, indicating an inducement and confirming a major high in this example. As the selling pressure weakens and bullish momentum resumes, the price is likely to continue its primary upward direction. In continuation, we see that the price made attempts to push higher, but failed to break the recent higher high. Instead, it formed an internal high followed by a minor internal pullback to the downside with this red candle. However, with increasing bullish momentum, the price made a strong upward impulse move, breaking the previous structure resistance and creating a new swing high. As a result, now have a break of structure to the upside and a demand zone associated with the break of structure located at the extreme, which has the potential to reverse the price. However, it is important to note that there is another nearby zone that has not been mitigated yet, creating a potential source of confusion for traders in determining which zone to trade. However, there are some crucial points to consider. As we discussed earlier, the upper order block serves as an inducement zone because it's the most recent pullback created before the break of structure, and we always anticipate the price to break below it. Therefore, we should not regard that zone as a potential trading opportunity. Another critical point is that, for a valid break of structure, we must wait for the price to form an inducement. Without the emergence of an inducement, we have no valid break of structure and, consequently, no valid order block for trading. In this case, the upper order block serves as an inducement, so we must not consider it a valid demand zone, as we always expect the price to take out that zone. The extreme order block is considered valid and safe for trading only when we have a confirmed break of structure. To achieve this, we need the price to form an inducement by taking out the upper order block. Only then are we allowed to regard the extreme order block as our point of interest for entering the market by opening a long position. Now let's proceed to the real chart and integrate all the concepts we've explored in this video. We'll examine how to effectively identify valid inducements in the market. But before we continue, it's important to note a crucial step in your trading journey: backtesting your strategies. Before applying any strategy to your real account, it's recommended that you backtest it at least 100 times. To help you with this critical step, here, we are looking at the Euro-Dollar 15-minute time frame. As you can see, market's overall momentum is bearish. In this scenario, the price has formed internal bearish impulses and pullbacks until it entered a temporary pause and started to push upward. We see that the price pushed upward, taking out the most recent pullback and indicating a valid inducement. With the emergence of a valid inducement, we now have a confirmed major low. Additionally, there is a valid break of structure as the price has broken out and closed below the major low, and the recent break of structure confirms this lower high as the most recent major high. Now let's identify the next potential inducement zone linked to the recent impulsive movement. As mentioned earlier, candlestick-based inducement happens when the price breaks below or effectively sweeps the liquidity of the lowest point of the bearish candle, representing the most recent valid pullback. Next, we need to locate the latest internal pullback within the impulsive movement that led to the recent break of structure. As you can see, this candle represents the latest internal pullback. Our expectation here is that the price will push higher, take out the highest point of the candle, form an inducement, and then continue with the bearish momentum. Now let's see what unfolds next. As you can see, the price pushed higher, but couldn't surpass the high of the latest internal structure, failing to form an inducement, and is now attempting to move to the downside. Therefore, this lower low is not confirmed yet, and we cannot consider it as a major low. Let's continue and see how the price action unfolds. Now we see that the price has pushed to the downside, breaking out and closing below this structure. However, this does not constitute a valid break of structure because the price couldn't form a valid inducement before breaking this structure, and this structure is not a valid major low. Therefore, we cannot consider this break of structure as valid. So this price movement acts like a single impulse movement. Now we see that the price has created internal pullbacks within its recent bearish impulse movement. As it is obvious from this candle, it signifies the latest internal pullback. Our anticipation here is for the price to rise higher, surpass the highest point of the candle, create an inducement, and subsequently resume its bearish momentum. Additionally, examining the upper internal pullback, we can pinpoint this order block, which holds a higher probability compared to the lower order block that we view as an inducement rather than a valid order block. In this scenario, our approach is to patiently wait for the price to push higher, surpass the latest internal pullback, sweep the liquidity of the inducement's order block, validate this lower low as the new major low, and subsequently confirm a valid break of structure. Given that the price has successfully executed a valid break of structure, we can pinpoint a supply zone associated with it. We believe this zone holds a high potential to prompt a reversal when the price approaches it. It's crucial to note that without a valid break of structure, we cannot pinpoint a valid order block. Our next step involves waiting for the price to push back up again and tap into our identified supply zone. Now let's see what is going to happen next. As you can see, price pushed higher, swept the liquidity above the latest internal pullback, generated an inducement, and after mitigating our valid order block situated at the extreme, the price reversed its direction and proceeded with even greater bearish momentum and eventually formed a new break of structure.